I'm saying that don't ask questions. Okay. So financial risk management. Okay. Financial risk management is a practice of identifying and analyzing and taking steps to mitigate or control the various types of financial risk that an organization may face. When you do business, you encounter with risk. Okay, business is always risky, as we know, and there are various kinds of risk which are involved in within organizations. Okay, so how do the organization manage those risks? Okay, apart from that, we're going to talk about the risk associated with stocks and other currency and everything. Okay, so let's understand, what are the types of risk an organization faces. Okay, so it can be, if you start with the top, it's debt usage and leverage risk. Basically, you use more and more debt. That means to finance a company, you require money, capital. Okay. Now, capital can be contributed either by equity or by debt. Either you take loan or you take equity from the shareholders. Okay. So, if you take more and more debt, then you become leveraged. Okay. So, debt usage and leverage risk. Now, debt is, always people or companies always take them if the company is huge, okay, and company requires lots of money, lots of funding, so company has to have to rely on debt, okay. But there are certain companies which are zero debt companies, which don't have to take any debt. So more debt, debt is always, to just to give you this thing that when you finance your operations from debt or equity, debt is a cheaper source of finance compared to equity. Okay. Why so? I'll explain that. And because it's cheaper, there are two reasons. Okay. I'll just first give you why that is cheaper. Debt is cheaper. Uh, First, we have to look at equity first. Equity, when you put your money in equity, okay, in business, you expect a good amount of return, isn't it? If I say I'll give you a 7% return and you put your money in my business, you'll not be interested. But if I am a bank and I say I'll give you 7% rate of return on a fixed deposit, you will be happy to give it, isn't it? Because the expectation from equity is much higher. It's around 15% or more. Fine. It may be 15%, it may be 20%, it may be 18%. It hovers between 15 to 20% in most of the cases. Now it all depends upon the risk. If the risk goes up, your expectations go up. You want 20% return. So it depends upon what kind of business you are financing. Okay. So if the business is riskier, then your expectations are much higher. If the business is less risky, then even a 15% return is satisfies your requirements. Now, there are two kinds of businesses. Mainly, I can classify them. One is consumer staple business, okay, which is like FMCG companies, which are making products which are for the general masses, for the consumers. Okay, these businesses are considered to be less risky compared to other kind of businesses which are called, which are discretionary. They manufacture discretionary or they sell discretionary products where you use our discretion. We can always postpone our requirement for their products like cars, automobiles, airlines, hotels, okay? Like those kinds of businesses where, if we are earning good, we will buy a car, we'll buy a house. Otherwise, we will just wait and for some time and we can always postpone in buying those products. So the companies which are in discretionary products, manufacturing or selling, they're uh, they have a very volatile returns or profits they earn over a time period. Because at times these companies perform very good because the economy is good and people keep buying the products. People can afford as the incomes are growing. By the time there's a recession or there is a downturn, then everybody keeps away from those products and their profit falls. So there, if you see their, their profitability, it will have a cyclical kind of a movement. So all cyclical companies are again riskier companies, but a company like Hindustan Unilever or Colgate, companies like that, or even pharma companies, these companies are less riskier because their products are in demand all the time. Okay, and people don't postpone their demand. People will buy medicines if they fall sick. People will buy all the, I mean, Hindustan liver products or products of similar companies, Dabur, because it's not, they're not bothered about whether there is a recession. Of course they will have some kind of a downturn, but as the population is increasing and as the incomes are rising, so they will always witness a very a good, I mean, kind of profitability. So I'll just show you, a site. Oh, he has not connected me with the internet, so I'll just do it on a hotspot. So there are companies. So I said that, uh, risk. Uh, so debt usage and leverage we are talking about, isn't it? So more debt is cheaper and the equity is costlier. The first is because equity is costlier because of the risk involved in putting your money into the business, and debt is cheaper because, as you said, it's an expense for a company and they get tax benefit. Whereas, the equity, the dividends are appropriation of profits and they come below the line after the tax company has paid the tax. It's a distribution of profits among the owners of the company. So they don't get any tax benefit. So debt is always enjoys a tax benefit, and equity because of the virtue that it's a risky, place to put your money in. So combined net effect is debt is cheaper and equity is costlier. Okay, fine. So that's why people use debt. Of course, debt is cheaper, but too much amount of debt can lead to a case of bankruptcy in a company because company has to service the debt all the times. If the company is not doing well, then they face very difficult situation in, servicing their debt. Whereas when the company is doing very well, so they are able to, service the debt, and because debt is cheaper and equity is costlier. So what happens in good times, it magnifies the profits of the company or returns to the shareholders. Not the profit, it magnifies the returns to the shareholders because debt is cheaper. Suppose debt, they are paying 10% interest on loan, and whereas the shareholders expect around 15 or 20%. So, for example, suppose you have 100 crore rupees, you start business with 100 crore rupees, your own money, and you are experiencing a 20% return on your capital. So that means you get 20 crores as your profit. So return on equity will be 20%. So your shareholders get 20% return. Now you feel that a business is expanding and you need more money. So you have two ways to finance it. Finance it from equity or take a loan. Suppose you took a loan of 100 crores. Okay. Now on 100 crores you are paying 10%. Okay. Assume that. Forget the taxation part of it. So on 200 crores you will be earning 40% because your return on investment is 40 crores. Okay, 40 crores you will be earning. And how much you are paying to the debt? 10 crores. So how much is left with you? 30 crores, and which is passed on to the shareholders, which is 100 crores. So their return magnifies to 30%, isn't it? So, so this is in a good times. In bad times, it can play the other way around. It will magnify the losses for the company. So debt is cheaper, amount of debt use can magnify the returns of the shareholders in good times, but it makes the company more riskier for the companies which are more cyclical in nature, more manufacturing consumer discretionary products. So they may face up cycle and down cycle. In down cycle they will struggle, and their returns to the equity shareholders may fall dramatically because of that. So so that is one. Okay, so but how much of debt and how much on equity? So that is again kind of a question which companies ask, how much they should take debt. Now, debt should be, it all depends on industry to industry. Okay, some industries don't require money, like Hindustan Unilever, they hardly require any debt. Reliance Industries, they may require huge amount of debt. Okay, so it all depends upon company to company, but they have to just find out their ways how to see that the level of debt doesn't go so much that will help, trouble them. Okay, so they should go for an optimization of debt and equity. Okay, so I'll just show you a site which I was talking about. So I'm just opening a site which you can also open along with me. It's called, and might not, I think many of you might have seen that. I'm just opening the right one. So it's called Screener. Screener. Okay. So I'll just open once again. It's called Screener. Now, I've come across many sites, financial sites. Okay. There are many great sites like Morningstar, monthlycontrol.com. But I found, this site is very user friendly because I've been using it quite often. It's a free site. Of course, there's a paid version of it. And I just checked, and the accuracy of all the information, I find it was 99.9% accurate information. Some students told me in one of my MBA class that sometimes the information is not accurate. It's not, this information is not accurate. Information is accurate. Only our understanding sometimes makes us feel that it is not. Because I compared, the Reliance Industries data with the Reliance Industries annual report. I found there was no gaps. Okay, it's the largest company conglomerate in India. Okay, so let's talk about, for example, let's take, now you should have an account. Okay, it's better to have an account. Okay, open a login ID if you don't. How many people have an account here? Just raise your hands. Okay, so people who don't have, please open an account, and and then it will become very useful for you. So you can search any company, like for example, Reliance Industries to start with. Okay, so it will give you a lot of data of the company, Reliance Industries. And do you know what Reliance Industry is doing? What business it is doing? Anyone? Petrochemicals, yeah. It started with textiles, Vimal Textiles, way back during Zero Money 5 days, and then it's a conglomerate. It is present in 6 business segments. It has well diversified company. Okay, and we are studying a subject called financial risk management. So one of the way is to diversify yourself if you have to manage your risk. So, they were into, two main businesses, which are, petrochemicals and crude oil exploration. Okay. What they do is they have rigs, and they do a deep digging of oil from the seafloor. So that is called the oil exploration business. And second is oil to chemicals, petrochemicals, where they convert the crude oil into petrochemical products. Okay. So which constitutes almost like, 60% of their revenue or business. But over the last few years, they have entered into other businesses like, retail business, digital business, and energy business, and many other businesses. So they have about 6 segments. I'll just show you that. So if you look at, their profit loss account of the company, so if you just see, sorry, so go to the profit loss account first and understand, what is their top line and bottom line. So this is quarterly, sorry. So go to the yearly. So all companies are supposed to report their profits and loss for the quarter, okay, and annual also they report. Uh, so we will see the annual as well as the quarterly, okay. If you look at their top line, in 2012 their turnover was 3,57,000 crores, okay, and as we go along, so in March 2023, their revenue has gone up to 8,76,000. It's a huge amount of jump. Okay, what is the kind of rate at what they are growing? We'll just calculate that. Okay, and how can we do is just tell me the numbers. Uh, just hold on. I'll just open a Excel sheet. Okay, so let's see the total growth right from the beginning till the end. Okay, fine. So what was their turnover at the beginning, first year, 2012? It is 357,677. Okay, 320,112. Okay, what was it? 357,677. So this was the turnover. And now in 2023, okay, 876,296, 396, 396. Okay, so these are the two numbers we have. And if we just minus this, so how much? 11 years, isn't it? Okay, 11 years. And then I just put my here, I go to the formulas and go to the formulas called rate, okay, and put 11 here, this number, okay, and the present value, we put a minus sign here and put here this number. Sorry, I just pressed enter, so that's why the mistake. So I use the formula again. So pick up the formula and put 11 here and present value will be minus this number, and future value is 8 lakh crores this thing. Okay, then if make an enter here, so their top line is growing at an 8% growth per annum, compounded growth of 8%. So you can always make it a little bit. Hanji? No, this is not return on equity. I'll talk about return on equity later on. This is how your top line is growing. The top line is growing at 8% per annum on an average. Of course, this is the last 11 years. 2012, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23. So it comes to 12. Okay. But we take one less for calculating the growth. Okay. Because 1 year, if 2 years data, we say 1 year. Okay. If the 2 year data is given, we'll use one. In 1 year, how much is moved? So 3 years data, we use two. So here we use one less. So it is 8.5%. Okay. So this is their sales growth. So if I say this is their sales growth, okay, then we look at their profit growth. Okay, so tell me the profit now, net profit. Okay, so if you look at this last figure, which is the net profit, okay, give me the net profit. Okay, just I am open. Okay, so 2012, 19717. Okay, and 2023, 77269. Okay, huh. How much it is? 7474088. 74008. Double eight. Okay, it will not make any difference. Okay, so we use the same formula. Just try to calculate and use the formula. So we use the rate formula. Okay, and put again 11 years here. Okay, and put a minus sign. Well, why we put a minus sign? Because it's like assuming that you are invested this amount and how much amount you will get back after so many years. Okay, fine. So why we use a minus sign? Because we assume this is the amount which you are going to invest. The formula says that this amount you are going to put and how much you are going to get after so many years. So 19,000 is going from your pocket and you are getting 74. That's the way formula has been worked out. Okay. So the top line is growing at 13%, whereas the bottom line is growing at 13% and the top line is growing at 8.5%. Okay. So bottom line is good. Fine. 13% profit you're earning every year. That's increasing. It's a good number. Okay. So let's go back to our this thing. So let's go to this place again. So let's look at some of the very important numbers. What I have done is uh, I put a lot of ratios here. Okay, fine. You can always do that by adding these ratios here. Okay, fine. So what you can do is during the lecture, you can always take a photo and then add these ratios for yourself. Okay, so it will give you all, but you can do that later because I'll be using this site quite often. So at the moment, just focus on what I'm covering. So their market cap is 15 lakh 93,690 crores. That means if you want to buy 100% shares of Reliance today, you should have this much of money, which is the largest market cap company in India, highest. Okay, 15 lakh 93,000 is the top company in India having the largest market cap. Fine. The largest market cap in the world is with Apple, which is close to about $2.5 trillion, equivalent to almost 60 to 70% of the Indian economy. Okay. So this is the value of the shares, market cap. Then the current price of Reliance is 2,356. Okay. Then look at now the more important was I was talking about. We'll go to the ROE and ROC later on because as we move along. So interest coverage ratio is 5.34. Okay. That means in layman language, they're earning 5 times more than what interest they have to pay. So anything above 3 is considered to be okay. If it is 6, 7, wonderful. 5 is also a wonderful number. So company is very comfortable. Okay. Because of this, if you go to their documents side, so if you look at their credit rating, the companies has got AAA rating from the financial institutions like ICRA, all those companies. I mean, Care. So this company is very stable, big company, conglomerate, present in all the kinds of businesses in the world. And coming back to Reliance. So now let's go to the balance sheet. Okay. Oh, sorry. Let's go remain here at the moment. Their debt equity ratio is 0.42. So that means 0.42 paisa is debt and 1 rupees equity. It's a good. Okay. Fine. If you look at Adani companies, some of the companies they would be having 2 debt and 1 equity, or 3 debt and 1 equity. So they're in heavy debt. So we can even check of any company like Adani, which was in news recently. So here the debt ratio is 1.56. Okay, as compared to 0.42 of Reliance, which is a bigger company than Adani. So similarly, in some other Adani companies, they have much higher debt than this. Okay, coming back to Reliance. So this is one source of risk for a company. They try to manage that. Okay, so and then look at the balance sheet of the company. Now on the balance sheet of the company, so these are the borrowings. Okay, 92,000 crores to start with. Okay, with I mean, equity capital is on top and borrowings this. And borrowings can be further classified into long-term and short-term borrowings. Okay, we are not worried about that. So at the moment, so now the borrowings have been growing up. It has gone up to 3,16,000 in the last quarter reported. 3,16,000 as against an equity of around 7.5 lakh crores. Look at the reserve surpluses and equity capital that belongs to the shareholders. So the ratio, if you calculate ratio, is gone to 0.42. So take a debt and divide by equity. So that we can do. Huh? Just look at, just do a calculation here. 3,16,316,697 divided by 750. 7,50,000. That is 7,44,000 plus 6,766. Now, the company has equity capital. Company has been earning money. So what they're doing, they're plowing back the profit back into the company, is increasing the reserves of the company. So the main source of reserve is coming from the undistributed profit of the company, which belongs to the shareholders. This is their money. Okay. Or it can be from an FPO if the company comes up with a premium on shares, so that adds to the reserve, or it can be because of revaluation of the assets, whatever. So the reserves are 7,44,000. So this belongs to the shareholders. Okay. So what's the ratio you got? So I can just 0.42. So it exactly matches with your number here. 0.42 somewhere. Where was it? First column, debt, 0.42. Exactly matching. Okay, fine. So 0.42 debt compared to 1 rupee of equity. Now, if you just want to know, how they have done, how they have progressed. So I'll tell you how to do that. Let me just, let's look at, are you finding Reliance Industries final? Yeah. So what I have done is I have just picked up all the data and exported to the uh, Excel sheet. Okay, all the data which is there on the screener. Okay, fine. So look at the growth, 8%. It is telling you the last column I calculated. Then the expenses, everything is there. So I'll share this. I mean this thing also, and this is, you don't have to put all the data. You can just pull it the data from the site itself. It will get populated directly. Some adjustments and it will become like this. So look at the analysis. Debt equity ratio. Today is how much? 0.42. A year back it was 0.63. Okay. Then 0.41, and then it started with 0.5. So they've been maintaining a very healthy debt equity ratio. Sometime it was close to about 0.8. So company has been focusing on deleveraging the balance sheet by paying debt from equity proceeds. So what the company has been doing is They're starting the business and putting huge amount of money by taking money from banks as loans. As the business grows, they sell some stake, or they come up with a right issue or an FPO, or sell some stake to some foreign investors like Aramco and other companies in past, and they participate in the company. They become the shareholders of the company, and whatever money they get, they pay it back to the bank. So the debt is converted into equity. So this is what they are doing, deleveraging their balance sheet by paying debt from equity proceeds, which means that most of the assets are financed through equity and company is financially healthy. Okay, so this is how they are managing their risk, not going too overboard on debt. Okay, fine. That should be paid by bottom line or now debt can be paid from bottom line. That's you're true, but now the bottom line may be required for, I mean, improving your business. You need money for expansion. You need lots of money, like Reliance. So they are plowing back that money back into the business, but their needs are again more than that. So they borrow money, okay, from the bank or from anyone, I mean, institutions, and then later on repay them and keep the leverage as low as possible, and so that they can magnify the returns of the stakeholders. Okay, fine. So now, if you look at the company, okay, for example, I'll just show you, one analysis by a. So they're increasing the number of shareholders basically because yeah, they're paying back the debt by increasing the number of shareholders, yeah, coming up with absolutely, new IPOs, absolutely, new shares. Absolutely, absolutely. You can just see that, that is very evident. You can see the share capital. Is it growing? How do they do that? And sometimes, they even, what they do is they even buy back their shares if they find that they have too much of capital. Okay. So I don't know whether they have bought in recent past. Look at their equity capital. Okay. It was the top line, 2979 crores. So this is the money taken from the shareholders. Suppose the face value is say 10 rupees. We can see that what is the face value. That keeps changing over the time. So now they have the share capital, issued share capital is 6,766 crores. Fine. When they give the shares to the company, this is at the current valuation of the company, not at the face value. जो 10 रुपए का शेयर है 10 रुपए तो दे नहीं देंगे. So they'll say that today the value is say 2,000 rupees per share or 2,300. So they will bring the new shareholders at a premium, and that premium will go to the reserves and surpluses. So either it will reside at equity capital or it will be part of the reserves and surpluses. If suppose somebody says I want to invest in today in Reliance, so he has to pay 2,300 or 2,000 close to the current market price. Okay. If he's going to acquire a very big chunk, so there's some kind of a premium also they have to pay because now they become, a decision maker in the company. So this okay, equity capital value is suppose in 2012, suppose the company has started in 2012. Yeah. And at that time the face value of the share was 10 rupees. Yeah. So this equity capital calculated in September 2023 is based on the face value of 10 rupees. No, no, it is based on maybe at 2 rupees. We'll check that. But this is the total absolute amount. Okay, this is an absolute amount. So let's see what is the face value. So that's why what I do is I always put that numbers here. Face value is 10 rupees. Today is 10. They have not split over the life. Some companies they split their shares from 10 to 5, 5 to 2, 2 to 1. Okay, but Reliance has stuck up to the face value of 10, which was original, and today also it's 10. Okay, fine. So this is for different purpose, but the value which is shown on the balance sheet is the total money value. Okay, whether it is 10 rupees face value, whether it's one immaterial. Okay, have you got it? How it is calculated on equity capital? Which is why do you have, so it is divided by 10 only, no? How many shareholders the company has? Okay, so you want to know that. So number of equity shares, 677 crore shares. Where it is? There, my cursor is there. So number of shares the company has is 6,677 crores. So it keeps on changing. You can always see the past historical data. But today, as on today, they have issued 677 crores shares to the everyone, to promoters, to investors, to everything. So you can always check, that also. 677 multiplied by 10. So yeah, multiplied by 10. Multiplied by 10. So you'll get the same number, 6,700 something crores. Okay, fine. So derived from there only. Now, if you look at the shareholding pattern, now the Ambanis hold 50% of the shares of the company. Okay, there, September 23. FIIs, the foreign institutional investors, they own 23%, 22.8. DII, that is domestic institutional investors, that is the mutual funds and other bank, everything, whoever is bought it, mostly held by mutual funds. 15.99. Government owns 0.7. Okay. And public holds 10.98%. People like you and me, we hold only 11% of the shareholders. Okay. So number of shares are also given. Okay. Fine. At the bottom. Number of shareholders. Okay. This is the number of shareholders. Now I may having 10, 100 shares of Reliance, so I'm counted as one. This is not the number of shares. This is number of shareholders. Okay. Fine. I never noticed there was a figure down. So you asked me a question, I was just thinking why it is less, but then I got the answer from my mind. That is only the shareholders and not the shares. Okay, fine. Is that okay? Is that clear? Now, so interest coverage ratio. So now look at the interest coverage ratio.
Sir, one more query I had.
Okay,
Even with their existing share capital, they can float more shares.
just hold on. I'll just see where is my interest coverage ratio. Interest coverage ratio there. What are you saying?
Even with their existing share capital that they have already, shares are in the market, they can float more shares.
Yeah, yeah, they can float. There it's like this. They can, how the companies can issue shares. The first time when a company issues shares to the public and it becomes listed, it's called IPO.
IPO.
Then, when the company subsequently issues, it has to issue the shares to the existing shareholders. That's called the rights issue. If the existing shareholders, they say that we can't contribute or the money is too high, then the company can take an approval from the existing shareholders by passing a special resolution as per the Companies Act, and the company can go more to the public by coming up with an FPO. That's called further public offering. Okay, FPO. That means they can raise further money from the public.
It will dilute the value of
Their
the
shareholders,
shares.
yeah, their own holdings. So that means, the promoters, they are supposed to invest at least 20% in the new issue when they're coming up. Okay, of course their 50% is Reliance, so they may come up with more. Over the time they have maintained around 50%, despite, I mean FPOs, IPOs, or rights issues, or any kind of there's something called private placement also, where you just, without, going to the public, you pick up a investor, large investor, strategic investor. He puts the money into the company. You choose your shareholder. Okay, there's one company in Saudi Arabia which says that we are going to put 10% stake in your company, so they'll allow it. Okay, fine.
But a resolution has to be passed for
That is they have to, they have to pass the resolution because they are bringing the money from, so shareholders have to approve that. Okay, fine. Now coming to the interest coverage ratio. Interest coverage ratio was 9.32 to start with, and then it became 8. Then now it is what, 5.34. So this is so a good ICR ratio should be more than 3, which is it is. The company has maintained a good level and not prone to the bankruptcy. So because the company has a good amount of interest coverage ratio. Okay. Now apart from interest coverage ratio, there's another ratio called debt service coverage ratio, which is very difficult to calculate by seeing the numbers of Reliance or any company, because it talks about, whenever you take a loan from the bank for your car financing or everything, so they look at your salary package and whatever you're earning. Okay, and then they work out your EMI, and they say that what is your salary. Suppose your salary is 100 and your EMI is 20, so your debt service coverage ratio is 5. Here, instead of looking interest, you add the principal repayment also every year. So EMI is a composite value of interest and principal repayment. So you add that. So debt service coverage ratio will be your profit of the company, not net profit, but the EBIT, earning before interest, this thing, and tax. That profit divided by the EMI, or the interest plus whatever you have to pay in that year, short term money which you have to pay, the loan installment for that year.
I think initially principal is paid and then interest is covered.
Most of the time the companies takes loans, so either they pay it, they may have some time, breathing time for 1 year, you don't they pay any principal, but then the principal schedule is made, so every year they're paying 10%, 15%, 20%. So whatever interest they're paying plus whatever installment which has fallen due, so that becomes their total money they have to pay in that year. And whatever profit they have earned divided by what they have to pay, that is called the debt servicing ratio.
ICR will be a bit divided by the interest.
So I'll just show you here. What I have done is basically, you're right. So look at, the formula here, interest coverage ratio, which is, income statement B8 divided by B9. So B8 divided by B9. B8, B8 is your EBIT divided by interest. Exactly this. Okay. So I'll share you the Excel sheet. Now I'll just ask you to make a WhatsApp group so that I can share you a lot of things. Okay. And I make a Google folder where I keep adding a lot of material which gets updated. If I just put it on a 360 campus, then I have to again put a new version. So every day I make some changes. So every day if I put a new file on a 360 campus, so you won't be, I mean, happy about that. Okay, because I keep changing. So every day I keep working on something and keep adding to my files. So I'll share a Google Drive and lots of other material, even the link of my lectures so that you can go and watch them. Why it is not the profit? Why not the bottom line at the end? Why the EBIT? Now, first of all, we are calculating interest coverage ratio. Okay. So the total profit of the company, EBIT, is basically the operating profit of the company. How much they earn. After that, it is just distribution of profits. Either you're paying tax to the government or you're paying interest on the loan which you have taken. Okay. And the dividends which you pay to the shareholders on the PAT. So EBIT is the pure profit of the company, isn't it? ये आपने प्रॉफिट कमाया इफ यू डोंट हैव एनी डेट सो एबिट विल बिकम योर बॉटम लाइन isn't it? So before paying any interest, like suppose you're taken a loan of say you have to pay 10 rupees installment and you're earning 100 rupees salary, so you don't take 90 rupees and then calculate your ratio. You don't deduct interest what you have to the bank. Absolutely, absolutely. Sure. Because again, when we are comparing this ratio, now the tax, have, in India, there are four kinds of tax rates for the corporate world. When you're comparing two companies across the world, they will have different tax rates. So when you're comparing the ratio, you should have one line, this thing. You have to compare, Reliance with some company in abroad. So if you take after tax, it will distort the number. So everyone will have a distorted number. So that's why people calculate either at the EBITDA level, earning before interest and depreciation, because depreciation again can change. Either you're following a straight line method or a written down value method, or you are in India, you are in America, different rates are different as per the companies act there. So if you have to calculate what is my profit and you have to compare another company, do it at EBITDA level. What is the EBITDA margin or EBIT level? So that will make your analysis much better rather than making on a net profit basis. Haji? Yeah. Now it all depends again which company it is. It is industry specific. If it is a bank, EBIT. If it's a large company, then EBITDA. Large company means huge investments in fixed assets. So it will distort the EBIT level profit. Okay, fine. So EBITDA is very good because if the company is huge, like Reliance, EBITDA would be always better. Okay. But for calculating interest coverage ratio, we always assume EBIT. But for calculating, understanding our profitability, like operating margin at the top, sales minus expenses, it's called EBITDA. Okay, so operating margin. So this tells you what is their profit of the company they're earning. Suppose you bought something at 100 and selling at 120, your EBITDA margin is 20%. To put it in a very straightforward method. Okay, so if you look at the EBITDA margin of Reliance and see, how it is done. 9% to start with, 8%, 8%, 10%, 15, and now it has gone up to 18%. Is it improving? Yes. The company's margins are improving. Why? Because over the years they have diversified their businesses into other businesses than oil business. Okay. From oil, they have moved on to retail business. I mean, Reliance Geo, digital business, media. Also, they own, CNBC and moneycontrol.com and many other businesses. Yeah. Yeah. So EBITDA is basically the operating. That means sales minus all your expenses before interest depreciation. Okay. Fine. And before adding any other income. Fine. We are taking the operational income of the company, EBITDA. Okay. So sales minus expenses. Like suppose you bought something at 100, you just converted that into a product. You bought a raw material 100, and then you hired some people and converted them into a product, and it cost of conversion is say 50 rupees. So your operating expenses will be 150. So all those expenses which actually led to an increase add on to the value of your product will be your expenses. Fine. All expenses, not only just the cost of manufacturing and the salaries, wages, everything. All the expenses except the depreciation and other income and interest. Okay. So all other these things. So all expenses are put here. Fine. all the expenses the company incurs other than depreciation, interest, and tax. Okay, and no other income included. Fine, because other income will be coming from, for example, some other sources like treasury income. Company has huge sitting on a huge amount of money. They have the largest cash and cash equivalents with them, so they just put the money into some treasury fixed deposit, like we put in fixed deposit, they put in liquid assets, liquid investments, and they earn some money. So that money is actually coming in the other income. That's not part of their main business. Okay, so we look at EBITDA. That is the pure margin from their products and services. Okay, so that is increasing. So basically, this is your, look at the formula here. It is B6, B4 divided by B2, which is, we can just go to the formula here. We can always, the formulas. So we can check the formulas. It is this, okay, which is the the B4, which is EBITDA, divided by B2, which is your sales. Okay, fine. Okay. So this is, so their operating margins has been going up. So this is a very great story. Why it is growing up? Because if you see, their businesses are becoming, they're diversifying. So this is the way they manage their risk. So I'll just show you here. So there is a PPT which I have here included here, Reliance. So all this information, I pick up from where we go to the annual report, okay, and there is a section called management discussion and analysis report in every balance sheet, okay. So it will give you, and Reliance is done beautifully, okay. They have given everything there. You don't have to go anywhere except the MDA report. So business segments. So these are their business segments: oil and exploration. That means they, dig oil from the seabed. Okay, so crude oil becomes their final product. Okay. Now, this is what the downstream, isn't it? Upstream. This is the upstream. Okay. So again, if the crude oil prices go up in the market, today it's hovering around $85 a barrel. A month back it was 90. It keeps changing. So the crude price becomes their selling price. Okay. So if the crude price falls, their profitability comes down. Okay, because that the top line comes from whatever they're manufacturing. So their manufacturing cost remains a fixed cost. If the crude price goes above 100, so this part of the segment becomes very profitable. Okay, then oil to chemicals, it's the reverse there. It's a upstream. You know? So here the crude oil becomes their raw material. Okay, if the crude oil falls, it becomes good for oil to chemical. Their feedstock or their raw material falls, and then they become more profitable. So they keep expanding at the time when the crude oil falls, and they become very profitable. So Reliance is a company which has a two-sided effect on both of the petroleum product. So they will have, because the oil to camel business is very large, so always it favors when the crude price falls. Absolutely. Then they are into retail business. So many retail businesses, I'll show you. Then digital services. Then media and entertainment. They own TV channels. They own many channels. And then the new energy business. Okay. So these are the new energies that just started. They're not reporting any income there. So retail business. So these are their retail businesses. They started with, Reliance Mart or something, Reliance Fresh to start with. Of course, now that business changed. So they're market leader in value fashion retail, multi-brand family footwear destination for fine jewelry, okay, apparel departmental store, international toys retailers, furniture, intimate wear, specialty retailer. So they are present in all kinds of businesses. Okay, fine. So Reliance Fresh, Reliance Digital, Reliance Market, all this stuff. Okay, and then if you look at the retail business, okay, out of 8,70,000 crores of the turnover reported last year, so their total turnover from retail is 2,60,000 crores in 2023 and 2,30,000 from operations. So 2,66, so 30,000 would be other income, okay, from treasury income or something. So from their value of sales and services is 2,60,000 revenue, and revenue from operations is 2,30,000. Okay, So it's given value of sales and service. So 2,60,000 is value from sales, and revenue from operations is 2,30,000. So it's been growing, from 1,57,000 crores in 2021 to 2,60,000, and revenue from operations is growing from 1,39,000 to 2 lakh. So 2 lakh, you should focus on the second middle figure. Okay, so that is the turnover coming the from the operations.
What is the difference?
So, that is what my guess is, that it is from either other income or it includes the GST also. Fine. So we'll check that. We have all the numbers. We'll check it. It goes past 9 lakh crores. That means the GST. Okay, fine. So I have the numbers before GST and after GST. We can always cross check that.
What is
Okay.
the difference between value of sales and revenue from operations?
So they are offering sales and services both. Okay, they are in the service industry also. So they're not only selling goods, they're selling services. Okay, this was your question or what?
Yeah.
So they're both. We'll just see. So retail, they offer some services also, isn't it? So we'll check what are the services. Okay. Then EBITDA, that is their operating profit of the company. So that has gone past from 9,000 or 10,000 crores to 17,000 crores or 18,000 crores. And their margin has gone up from 7.1 to 7.8%. Of course, the total margin is 18%, as we have seen. Okay, fine. But the retail gives you about 7.8 margin.
This is operating margin we are talking about.
Yeah, this is EBITDA operating margin. Okay. So this year the business opened 3,000 new stores, taking the total count to 18,040 stores. So they're adding almost like 10 stores every day. The business also added new growth initiatives to its portfolio for foraying into FMCG and beauty businesses. So this is how they are growing their business in retail. Now we come to the digital business. So Geo Industry leading net subscriber addition. So actually they are into Reliance Telecom, basically. The digital business was, look at the middle one. It has gone up from 76,000 crores to 1 lakh 1,000 crores in the 3 years. And look at the EBITDA margin. It's about 40%, 44%, 43%. The blue one. Can you see the number? Here. I think it's not coming very clearly. Okay. ये slide है, इसको zoom नहीं कर सकते. I'll zoom it when I go to the management development report. Okay, so I'm just reading the EBITDA margin is about 40%, 43%, and the EBITDA margin has, in terms of absolute value, it's gone up from 34,000 to 50,000 crores. Okay, then Geo Industry net subscriber addition was 29.2 million, with a monthly churn remaining stable at 2%. So every month they're adding people, and some people are number portability, they're leaving and joining other. So the churn is 2% every per annum churn. So we always used to look at the churn. When I was working in telecom company, so it was, say 2%. Okay, the benchmark like Airtel in those days was our, benchmark. So if they're having a 2%, we'll try to maintain that or try to better it. So if you do 1% when you say that we have done better, so number of subscribers are not leaving us. So they're sticky to our, this thing. After number portability, the churn numbers have gone up. Because earlier people used to never change their mobile because the numbers will change. Today, because of that, there's a company in the world called AT&T, which became bankrupt. Immediately after 1 year, all the subscriber left. It was the biggest company in the world and it collapsed because of the number portability. So when the number portability was about to come in India, so people were fearing. And Idea Cellular, AT&T was a partner. So we were called Birla Tata AT&T at that time. Then it was turned to Idea Cellular and now it's called Vodafone Idea. So Birla Tata AT&T was 33% stake in our company. So they had collapsed in the world. And when, government talked about number portability, so every telecom operator resisted. Okay, they said, we don't want number portability. We are still not ready because it requires a lot of, they were giving technical reasons for it. But of course, they were actually scary about that. But eventually it had to come, so nobody could stop that because world over is the norm is number portability. Anybody should be given a choice to, change their operator if they want, if they're not happy with it. So they're having a net addition 29.92 million. Okay, with a monthly churn of 2. ARPU increased by 6.7%. Now, their average revenue per user, that means total revenue of the company divided by the average subscriber they hold, becomes the average revenue per subscriber. It's currently hovering around 160 or 175 mark. At time when I was working, it was above 1,000 rupees. It was in 2001 when I joined telecom company, it was 1,000 plus. 80% was postpaid customers, and sorry, 100% was postpaid. There was no prepaid. And now it is 99% prepaid and 1% postpaid. Okay. And the tariffs have dropped from 16 rupees a rate per minute and 8 rupees incoming and 16 rupees outgoing. It's now, there is no tariff. You have to pay a fixed fees and you're allowed for unlimited use of data. At that time, when our chief marketing, he came with a plan. He said 900 rupees though, unlimited calls. And there's a huge cry in the whole company. What he's done, he's going to make the company bankrupt. फिर तो इतना यूसेज हो जाएगा तो हमारा को तो मतलब हम तो सर्वाइव ही नहीं कर पाएंगे. But the time is now where it's a norm. Yeah. Before that also, when we were having Reliance in limited way communication, and other players, or Reliance when it started by Dhirubhai Ambani, the telecom initially, they were also like a player. We used to say Reliance has missed the bus because they don't have much license in the this thing. Now everybody's they're gone at the back. They're in losses. Only Reliance is making money. So it's happened the reverse way. My CEO, said one day we were in having a town hall meeting. He says Reliance has missed the bus. They're not present. We don't have Reliance as our competitors. But now Reliance has taken the whole all the telecom companies. Yeah, yeah. Groundwork for so many years. I was when I left my job, when the GST was coming, so I was giving lectures for GST, how it is going to impact the whole industry. So I was going to company and telling them. So I got a call from Idea, from my junior. Uh, she's Nandita. She said कि सर आप हमारे यहाँ भी तो आके एक GST का करो, वन डे का सेमिनार. जैसे ओके, मैंने अभी तो मैं बहुत बिजी हूँ 2 महीने के लिए, बट आई विल कम इन जनवरी. By the time, in those 3 months, Reliance had played havoc. So I was calling Nandita bhai, अब मैं फ्री हो गया हूँ, मेरे से सब चीजें बंद हो गई हैं. We are not calling anyone, so we can't spend even a penny today. No sanctions for anything. So this was the kind of a situation which happened. अभी भी ऐसे ही. It is, when I joined Idea Cellular uh, from a manufacturing company, my salary doubled from almost like 60,000 per month became to 1,25,000 rupees per month. And when talking about 2003, and after 3 years, they said you will not recognize how much you are getting your salary. It becomes around 4 lakh rupees a month. They were giving huge bonuses and salary increase. They wanted to, the company was not making profits. We were still in losses, but the company was growing because every year we were having 20% more, expansion. So they started giving huge amounts of, bonuses and salary hikes, and they were acquiring other companies. So they acquired Escotel, which was owned by Escorts. So their salaries were about 20% higher than us. So they wanted to match. Before the integration happened, they increased our salaries by another 20%. So every year a huge amount of bonus, 10 lakh rupees bonus, 15 lakhs rupees bonus we used to get. So, and it was like, a kind of a thing that working in a, telecom, or working from manufacturing to a service industry was kind of a good move by me. And I was feeling so happy and was learning something new, telecom, a new kind of a business, and understanding, how the technology works. It was very exciting. So, but thereafter, things have changed. People, last 2 years, my secretary who was working with me in Indore. So earlier I used to talk him, he was very happy. But last 2 years, he's frantically calling me, sir, koi job hai? Because he's been out of the job. Okay, but he found a job in somewhere in Indore because he belonged to MP. I said, मैं तो दिल्ली में हूँ. Now I'm retired. I'm working in colleges. I don't have any, clout in various industries. So आप try करते रहो, मिल जाएगा आपको. फिर भी आप अपना resume तो भेजो. I can't say no. So everybody sends a resume to me. I just keep it in my Yahoo Mail. I can't do anything about it now much. Only in Idea Seller I used to employ a lot of people, but there also things are blocked now because they are not taking any people. They are not hiring. Okay. So coming back to this. So digital service. They got into AGR issues. Yeah. 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 So we'll come to the AGR issues also. We'll
What
discuss
is
both.
the ideal debt service ratio that the company should have?
See, interest rate coverage ratio is 3. Debt service coverage ratio would be slightly higher, maybe 2.5 or something. No, not high, but it should be, because we'll add the borrowings also, so the ratio will fall. Not high, it will fall. If the 3 is a threshold for interest coverage ratio, then debt service coverage ratio should be slightly less than 3, but should not be, should be above 2.5. This is my hunch feeling, okay? But we can always check. We can always, make a research and say what should be the ideal debt service cover, because it's not widely published ratio, because you don't get the data of the companies, how much they are going to pay this year. Of course, we can make some guess. Whatever they have reported as short-term borrowings, that means any borrowings which is reported as short-term would be falling due in that year. Okay, so we can simply presume, but it will not be an accurate assessment. Okay. Yeah, so only it's privy to the company only, okay? So if you can just search in the or annual report, suppose they have given that amount, you'll be lucky to get. Okay, fine. So this is their this thing, business, and then oil and gas exploration business. Okay, so this is the business which is, again, the oil price goes up, they make more money. If the oil price goes down, they lose, because this is their final product. Okay, so here the turnover is not big. It's about, it started with 2,140 crores to 16,000 crores of revenue, and EBITDA has gone up from 258 to a staggering figure of 13,589. So which means the oil has favored them in this, in this couple of years. Okay, because the oil prices were around $60 a barrel, it touched about close to about 95, 96 that barrel till this time. So because of that, the company has gained a lot of money in this period. Okay, so they are having a KG Krishna Godavari D6 basin, from where they are approximately, which account for approximately 30% of India's domestic gas production. So 30% of the gas production of India comes from this oil field, and they have a 30 million metric standard cubic meter per day capacity. It's around 20 something, 20 plus, but they are going to soon hit a peak capacity of 30 million metric standard cubic meter per day. So this is their capacity. So the domestic production was 10-year high. So their production also went up, and the oil also favored their business. So their profits also gone up. Then the crude oil business. Basically, second is petrochem, oil to chemicals business. Okay, oil to chemicals. Look at this. This is the huge business. Their, revenue is basically gone up from 3,20,000 to 5,94,000. But the margins are very less. It's about 10%. Okay, fine. It has gone up from 38,000 crores to 62,000 crores. Uh, Financial year 2020-23 witnessed a rise in demand for transportation fuels, with increase in travel and normalization of economic after COVID. So economic activity has picked up a much. Okay, so yeah, absolutely. So it's a very, business which requires a lot of, cost of, I mean, converting the yeah. So we'll come to that. The operating leverage in financial. This is part of our study, so we'll understand that. Okay. Domestic demand for oil, polymers, and polyester showed a strong growth. So crude oil price rose sharply, with Brent price averaging 96. So, when here, if the crude price goes up, it adversely impact this business. Okay, because this is basically the raw material. Okay, but still with this, because there was a huge amount of demand for these products, this was a positive, and the negative was the crude prices has sharply in the current year. That's the 2022-23. Okay, from 60 to 93 it went. Okay, during this period. So then the media business. So advertising, this is basically, they have a revenue from operation of 6,000. It's a small segment of the business. From 4,700 to 6,000 crores, their revenue has gone up. And if you look at, the profits have declined from 840 crores to 236, because there are hardly people giving an advertisement, because of after the COVID impact, most of the people, the advertisement started falling on the media platform. Advertisement revenue was impacted by economic slowdown and high inflation, which constrained advertising budgets of the companies across sectors. Withdrawal of Color, Rishte from DD Fresh, Dish free to air platform also affected the advertising revenue. So because they're having some platforms which they sold them, okay, and or they exited those businesses. So so media business, their margins are only 3.8%, which was about 18% a couple of years back. Then, if you look at the credit rating, and of course they have a one more business which is called the energy business. which they have not reported any revenue. Maybe in the next year they'll have. So O2C is having 41.5% contribution. Digital services 33, which is a very huge profit margin business, and oil to gas, retail, and others. So they're well diversified, kind of a business, and their credit rating is basically international rating is triple B plus. Now India has a rating of triple B plus. Okay, in India they get a triple A rating, but abroad the rating falls because India is a risky destination. If you look at it from the angle of foreigners, okay, so India rating is not triple A. US rating maybe triple A it was and it came to double to A, but maybe they bounced back to triple A. But India is considered to be a risky destination. Okay, and a triple A B rating is that investment grade rating. Below this, people are not going to invest in that country if it is below triple B. So we are enjoying the same rating, having a same rating at par with the India's rating. Okay, fine. So all the Western world, maybe America is having, because as the economies become larger and more prosperous, the rating improves. So we have been always, clamoring for trying to, increase our rating, but it all depends on the international rating agencies. Though we are growing, but still there's some risk involved in our growth story. So that's why the rating is triple B plus. Okay. So this we have done. Okay. So now we just move back to अभी break कितने बजे है? 10:30. So we'll just continue for 5-10 minutes and then we'll have break. काफी ground हमने cover कर लिया है, मतलब lots of things we have done. Coming back to our slide again. So debt usage and leverage risk. Okay, so we will be, of course, we just did a case study about Reliance, but we'll be covering some theory part and some more explanation to the leverage. Okay, the operating leverage and the financial leverage, which is part of the slides. If you just go back, ahead of these slides. So there is all leverage types of leverage. It's a very interesting part of understanding. So, but we'll touch that later. So then we have, the risk called foreign exchange risk. Okay, because the foreign exchange can spoil the party. Like India currency is mostly depreciating against US currency. Okay, over the time, we started way back in 1940s when the dollar was equivalent to 4 rupees, and today it's about 83 rupees. Okay, for importers, the import stuff become costlier. For exporters, it's a good thing because they find more. So it all depends how do we manage the foreign currency risk, and we are going to spend the time. We can do it either by taking the help of the stock exchange or by taking a forward cover from the bank. So today we are going to cover that. Okay. Then operational risk that is derived from your people, processes, your systems. If the system of the company is not good, the processes are not good, the company can go down. Okay, fine. So operational risk refers to the chances of loss stemming from an issues with people, systems, procedures, and external events. Then we have the commodity risk. As we have seen in Reliance, they're the company which has hugely relying on commodities for their business, crude oil. Okay, and the crude oil price can always make their company more profitable or less profitable. So many companies buy aluminum, iron ore, coal, all those stuff. So the commodities can always that risk is there. So how do we manage that risk? Then interest rate and credit risk. Interest rates keeps changing up and down. So interest rates become more, it impacts the bottom line of the companies. They rely on the debt. And when the interest rate goes up, some businesses are impacted because their final product sale is dependent on interest rates, like in houses or the automobiles or white goods. So when the interest rate falls, the EMI become cheaper and people buy more of their products. So these are all kinds of risks associated to business, and we'll see how we cover them. Okay, to manage these risks, organizations employs various risk management techniques and instruments such as derivatives. So we are going to understand derivatives. Fine. And the insurance, we can insure our products. Diversification, as we have seen the example of Reliance. A risk assessment and modeling. Okay. And policy procedure, you make a policy, you make a strategy, how you're going to counter those kind of risks. Like, for example, a company like SRF. When I was working in SRF, it was a company, again, Reliance, again, like Reliance, they have diversified. They were only 80% of the product was tire cord fabric. And they were making tire cord fabric from nylon. and it was going into tire manufacturing. So the nylon uh, fabric we are selling to Seat, JK Tires, all the tire companies, Dunlop or Bridgestone, Apollo Tires. So there were seven or eight handful companies in India who buy, tire cord fabric from our company. And so we were selling tire cord fabric to all the companies, and we were having market leaders. 50% of the market was controlled by us, and that time 80% of the tires were manufactured out of the tire cord fabric, and 20% were radial tires. Radial tires has just begun, and as it said that as the roads improves, so people will migrate to radial tires and less on the fabric tires. The fabric is a loosely woven fabric which goes into the tire manufacturing. The tires rubber. It becomes a reinforcement material. So when the tire moves on the earth, when the along with the vehicle, so it doesn't break up. So the fabric will hold the tire. Like when you see the roof, on the roof there is a loosely meshed iron fabric there is there. Okay, if you've seen when they put a iron on this thing. What do you call them? Iron mesh or something. They just put it on the top. So that becomes, हाँ जी, नहीं आरसीसी नहीं, ऊपर पूरा एक छत पे मैश बनता है ना, उसकी पूरी ऐसे लाइन करके सरिये लगते हैं उसके ऊपर, चारों तरफ से बिकम अ like a loosely woven kind of a thing of metal, and then they put the concrete on that. Okay, RCC तो सिर्फ पिलर्स के लिए होता है ना, isn't it? If I'm not a civil, हाँ स्लैब ही बोलते हैं वो, पीसीसी आरसी स्लैब होता है. I'm not a civil engineer man. Iron mesh. So that mesh is basically a reinforcement material. That's a load bearing of the wall. Okay. So if you put anything, so it should have some kind of a strength so that it can, withstand any earthquake or withstand any load which you put on the floors. Okay. Fine. So similarly, a tire cord fabric helps the tires to remain bound with the rubber. Okay. So that was, the business earlier. 80% was we were supplying, and we were having 6 or 7 factories in India, which was manufacturing this tire cord fabric. And just to give an example, this thing, that time, year when I was there, the share price of Reliance was just 8 rupees. A 10 rupee share was selling at 8 rupees, below par. And we had just reported a profit of almost 1 crore. And we used to have an annual meeting, okay? Every year, leadership meeting where we used to have the CEO of the company, the owner of the company, the Bharatram Charatrams, Arun Bharatram, who was the owner and promoter, and around 100 people all across the globe or India, the managers, chief manager. I was the junior most chief manager at that time. So there will be presidents, vice presidents and everybody. And we used to meet there and finalize in 3 days' time. We used to work out what will be our plan for the next year or going forward. So it's a very interesting story, though I'm just doing it at the end. Okay. Rather, I would have told this story after the break, but just bear with me sometime. So there was a meeting, and we reported a 1 crore rupees profit. As an accounts person, I knew that we were not making a profit making company. We had just window dressed our balance sheet and profit loss and reported a figure of 1 crore. We never wanted to annoy our shareholders. And then, our CEO, who was Ravi Kesina, he was a MBA. He came from Agra University and joined the company. And in 17 years, he became the managing director of the company. And he was virtually the running the company, single man company. The owners was taking a back seat. So he was making a presentation in the morning at 9:30. The meeting started on 9 o'clock. Sharp, sure, I think everybody has to be there. He was very serious kind of a person, but very humane. So he started the meeting and he said that, I want to share a plan for the next year. And, I may tell you that, we may be offering shares to all the employees of the company who are present in this hall, like 100 people. It's not like ESOPs, but now we call them ESOPs. He said, you will get shares. Okay. Everybody is going to become a shareholder who's present in this hall. And at my level, I was getting 10,000 shares, and I had to spend 1 lakh rupees for buying those shares. 80 rupees, 80,000 ke shares, I had to pay 1 lakh. Okay, and they said, this is the money which you will be paying, and you will be getting 10,000 at my level. Somebody was getting even 50,000 shares, maybe president level. He says that, this is our story. We are currently at this stage, and next year we are going to make 40 crores of profit. As I can see, economy is improving and our fortunes are going up. So we will be making a profit of 40 crores. And next year, we'll be making 100 crores profit. And the third year, 3-year plan, 200 crores. And the share which we'll be holding will become equivalent to 300 rupees at the time after 3 years. So he was just selling the story to us. We were 100 people. At the morning, we were just saying what this he's saying. I mean, we couldn't believe it. And we were just smiling and just trying to, stop ourselves from reacting. It's how it's possible. He's just selling a dream to us. And he spoke for about an hour or so, gave us a full plan, how we'll be going to achieve it. Nobody was with him at that time. Everybody had their own version that, so अभी तक तो कुछ हुआ नहीं, अब क्या हो जाएगा आगे? And there was a break, a tea break. So we came out. So most of us, just went to the washroom, and there we started laughing. Someone says, what he's talking about? So, so this was a kind of state of affairs. And after the break, when we came, the MD of the company realized that people are not convinced by what he was saying. So he asked all the people, "Are you not convinced that we will be doing this?" Now nobody can say no. He said, "No, no, sir, we can achieve it." He said, "Just raise hands that we can do it. I mean, raise hands if you really believe that we can do it." Everybody raised the hand. And just 5 minutes back, everybody was laughing that it can't be done. First year passed. We made a profit. The target was 40 crores. We made a profit of 100 crores in the first year. First year itself. Now, Ravi Kesina, the chief CEO of the company, he said 100 crores is too much of profit. Let's do one thing. We'll report only 40 crores. How we'll do? We will, no, not expensive. The company was very, very ethical. We never paid any single penny as a bribe to any guy, whether it's income tax, SI, or whatever. He used to never. Absolutely, we'll go to the court, but we'll not pay even a single penny as a bribe. And do very ethical person, I mean, company SRF. So he says, we are going to, make provisions. If some of the customers have not paid beyond 4 months or 3 months, we are going to make a provision. If there are some stores spares lying in your places or something which is not moved, make all provisions. They have one company which is in huge losses, we'll completely write off that company. Okay. There's a company called Shriram Needles Bearing something, so we completely write off their assets. And we brought down the profit to 40 crores. Our balance sheet was absolutely clean. Nothing. I mean, only the assets which were being used, they were reported as assets. Any asset which was not moving, I mean, not producing anything for the company, they were all made provisions or written off. So we brought the profit to 40 crores. The share price went up to 100 bucks. Then next year, the profit was 200 crores. Then 500 crores. Like this, the profit started moving up. And I had 10,000 shares. The share price went up to 12,500 rupees. So it is worth 12.5 crore rupees shares, which I got at 80,000, 1 lakh rupees. And they told me that I don't have to pay all the money upfront. Some 350 rupees will be deducted from my salary every month to pay off that money at a 3% interest rate. So we formed a society where the loans were given to all the employees to finance their portfolio and the company. And then, what happened in last year? They announced a bonus issue, 1:4. So now the share price has fallen to 2,500, but I have not 50,000 shares. Okay, but equal amount. So this was the story of SRF, how it has moved. It has become a conglomerate. It has a market cap of 70,000 crores, which is the size of a large cap company in India, and it is present to many businesses. They have diversified from only the net terracotta fabric to chemicals, mainly chemicals. Okay, but into various kinds of specialty chemicals. I'll just cover that later on after some time, not today. So the company has grown from that level to such a. But unfortunately, when I left SRF, I joined, I think telecom, and then the newspaper Economics Time, it came on a headlines, big headlines. The professionalism goes out of SRF. Ravi K. Sinha was sacked. The chief operating officer of the company, who brought the company to such a height, he was removed because the sons of Arun Bharatram, Ashish Bharatram, and other Bharatram, who were managing some other businesses which were not doing very well. They came of Mattis car and other cars, Cielo car and other things. They all, business was not good. So they came back to SRF and asked their father that with this guy on the helm, they can't run the show themselves. They can't own the company. So first remove him. So he was removed, and then they took the charge of the company. But since that, the company has not seen a back. It's been moving. Okay. So we just end up here. Just let me just close the recording.